Good morning. I'm Jane Morgan, and welcome to the Lithium Power International Investor Webinar. Yesterday, the company released an ASX announcement, which provided an update on the results of its updated definitive feasibility study for the Stage 1 Maricunga Lithium Brine Project. To run through the update, I am joined by CEO and Managing Director, Cristobal, Garcia, Huidobro. To ask a question throughout the presentation, please use the Q&A function at the bottom of the screen, and a recording of this webinar will be available online in the coming days. Cristobal, I'll now hand over to you.
Okay, thank you, Jane, and good morning, everyone. Thank you for attending the call today. Yes, we're very pleased to provide the details of the updated definitive feasibility study for our Maricunga Stage 1 project in Chile, as well as to give some color on different aspects and address some of the questions received during the last hours from all of you. As you also, the study confirms that Maricunga Stage 1 will be one of the world's lowest cost producers of lithium carbonate with a very solid ESG strategy, which is very important nowadays. The project supports a 15.2 thousand tons per year production of lithium carbonate battery grade for 20 years, with an NPV that reaches $1.4 billion US dollars on an after-tax basis at an 8% discount rate, providing an IRR of 39.6% and a very attractive payback of 2 years. The estimated steady-state annual EBITDA will be around 325 million US. The project operating cost places Maricunga among the most efficient producers with an OPEX of around $3,700 per ton, not including any credit from KCL that will be considered in the future as a byproduct. KCL was not considered in this DFS, and a decision about this will be taken after the project starts its operation, depending mainly on the prevailing market conditions at that time. Remember that for the start of a KCL operation, a minimum stock of salts from the port, the pond harvesting needs to be accumulated. Now, the project direct development costs are estimated on $419 million, with indirects of 145 and contingencies of 62 million to provide a total capex of 626 million for this Stage 1. I will address this issue more in detail in a couple of minutes. Now, the Stage 1 has an exceptional ESG profile, and we really aim to achieve a carbon neutrality once the operation beds down, setting new standards mainly for social relationships, which is something very important here in Chile. Certification process is being led by Deloitte and will continue during upcoming years as the project moves forward. As we have previously informed, the project infrastructure, including water rights, have been secured by long-term contracts during the project construction and operation. The access to the national power grid has also been granted years ago, ensuring future power supply that will include an important component of renewable energy, mainly solar energy. All the cost inputs for this revised DFS included all from the EPC contractors and the proposals that were 2020. And what that basically preliminary indications of interest, as we have said before, have been received from international and Chilean equity financing of the project, and will continue, of course, and speed it up in coming months. Updating of the EPC proposals will now commence by the end of the first quarter this year, with a final investment decision expected for the end of the year, with construction to start immediately after. Now we are very pleased with the results of this DFS for our project. Strong economics as well as the exceptional sustainability profile that the project has confirms the high standard and attractiveness of it. The priority, like I said before, for this year will be to finalize the project finance for the stage 1, and for which we are actively working with both international and Chilean financial institutions on different structures for debt financing, as well as with potential strategic partners for the equity investment of the project. We're continuing to work also on the development of a subsequent stage 2 at Maricunga, considering the current significant forecast growth in lithium demand, and of course stage 1 being on in its final phase of pre-production. This will also benefit from the maturation of new production technologies in the lithium industry, which we expect will realize the full value of our assets. Now, I would like to take some minutes to address certain aspects and answer some of the questions that we think are important to be clarified. With regard to our target production, as you all know, the stage 1 project is based only on our old code concessions. There are main two aspects that needs to be understood with regard to the lithium production at a salar, which is very different to a traditional hard rock mining, and which are first that you need to have enough resources, and of course, and second, that you need to be able to comply with environmental restrictions that are imposed by authorities once the pumping from the salar starts. On the first one, during September, you all know, we released our updated resource report, which confirmed a measure and indicated resources of more than 1.9 million tons of LCE, down to 400 meters on our old code concessions. So we do have enough resources for the project. Now, on the second aspect, environmental aspect, our environmental permit incorporates a very dense net of monitoring wells that will be used to measure the drawdowns at different areas of the salar. Those drawdowns are defined, and there are limits that can be passed to avoid basically triggering the early alert plan of the project. So that's those two things combined, as well as, of course, others more technical matters or issues, are reflected on our model that is used to predict the operation of the project. So in order to avoid any breach of mainly our environmental permit, we decided to initially limit the production of the project to these 15.2 thousand tons per year. There are some pending optimizations on the production plant that will be implemented once the operation starts, and will let us to increase the production by pumping the same amount of brine in around between 5 to 7%. And why we didn't, incorporate all these optimizations today, it's because you need to close your engineering at a certain point to be able to move forward, and these other things will be, different optimizations that will be done, once we have been on the side of the price mates. As this DFS shows, which is a vacancy unit, and it's basically based on the supply-demand equation prepared by Roskill that factored in all the current production and future developments, including operations. These estimates are very conservative, and we really feel very comfortable with them. Now, with regard to the capex, It's important to consider that the previous DFS was closed in December 2018 and released in January 2019. So almost 2.5 years ago. So since then, significant increases on the prices of the main materials used for the construction have been seen. Steel, titanium, etc., are all up more than 60% from that moment. And also COVID have had an impact on the labor costs everywhere. With all the governmental aids during the pandemic, a lot of people basically don't want to work to avoid losing those benefits. So in sum, regardless the pond's area, production plants and other infrastructure are slightly smaller, reflecting this reduction from 20 to 15,000 tons production. The capex have not decreased proportionally to this. However, if you see the direct capex and compare it to the one that we have in 2018, that showed a reduction of around 8% compared, like I said, to the previous one. But the real change on the capex and real increase came from the side of indirect costs. And here, one of the more realistic ones in the market today, as those actually are considering the real indirect costs that we received within the proposals of the EPC companies when we, conducted this international bidding process for the EPC. So those are as real as they can be. Commissions, fees, etc., are all big items that, unless you have a real quote for it, it's very difficult to estimate. Now I want to go to a different aspect that's very important, which is the financial structuring and the timings. That I know it's one of the concern that everyone has. On the side of the financing process, without the new DFS, the only thing you are able to get from financial institutions are initial LOIs, which really doesn't have a real weight at all. So now that we do have this very important piece of information, which is our updated DFS, every financial institution will review it as part of a due diligence. And believe me, due diligences from financial institutions are very detailed. The interest is there. We have been receiving a lot of calls from different institutions. Everyone was waiting for this document, and now it's time for us to speed up things on this regard. We have been working with Japanese institutions and also German institutions. As you all know, our main provider for the production plant is GA Meso, which is a German company. Now, what's really important is that the project showed a significant increase in value, and that sets a completely new base for any negotiation with the strategic equity investors, and also in terms of the debt. It has a very positive impact on how much debt the project can support because of our new cash flows. We feel very comfortable, like I said, now that the project will be able to meet our initial expectations in terms of the financing structure and also in terms of the debt level that we want to have for the project. Now, in this same context, we continue working with Mitsui, that now that we finalized the DFS update, will start its due diligence. At the same time, we have been receiving some unsolicited approaches from different companies, mainly Asian companies, that are very interested on participating in the project in some form. All those are being addressed with our financial advisors, and will be, the market will be informed in a timely manner with this about these issues. Finally, with regard to the timings, we really need to consider the time that will be needed by all these financial institutions and potential equity investors on the execution of the due diligence process each one will have, as those timings are really not under our control. We considered appropriate to add an additional time for the whole process. Now we're expecting to have a final investment decision by year end. Of course, the objective will be to close this sooner, and we will keep, again, the market informed of the advance of this process in a timely manner. Now, on a different aspect, we know everyone is interested also in knowing the future plans of LPI with regard to potential expansions of our assets in Maricunga. Please understand first that the DFS is a document that needs to be prepared for both York and 101 international standards. So there are very strict rules to follow, and you can't say more to, especially if that will imply to take certain assumptions for it. We will address these future expansions. We will address this future expansion on a different release in the near future. However, let me tell you, the evaluation of new production technologies results have been very encouraging. Things are not as or in other words, outside and just to solve certain things. And we expect to be able to start that testing very soon. This, no doubt, this will be the base for a future expansion. In this same context, a future expansion will be able to benefit from part of the infrastructure already built for the stage one. So in terms of that's intensive in the future. Now, from a valuation point of view, regulations don't let us to numbers, but we think should be of the same size, probably as a stage one project, and you already have a very detailed estimate of the economics of this stage one. So please start from there. Now, in terms of the ownership structure of any expansion, it will depend on different things and basically who will be the partner for this future development. But in any case, LPI is the owner of the mining concessions, and those have already more than 5 years of work on them. So we're pretty.
Cristobal, I might actually just ask if you can turn your camera off. That just might help. We're having a few audio issues from our end.
5 years less in terms of the total development time. Sorry, Jane.
Cristobal, I might actually just ask you to turn your camera off. We're having some audio issues from our end, and it might just help with the audio issues.
Give me just a sec, please. Okay.
Thank you.
Like I was saying, having these 5 years of work already on those concessions that will be included on a future expansion, it's a very important thing because it basically means 4 or 5 years less of development for the total time for a new project. So it will be very attractive for a future, or any future partner interested on getting into the country. Finally, I would like to take a couple of minutes just to say a few words about the current political situation in Chile. As you all know, a new president was elected last December. Even though they are from a more left side, growth from a political point of view, I mean, growth is the key aspect of and will be the key aspect of this new administration. And the country really needs to reactivate its economy, after the pandemic. And in this regard, they really need to show that they are able to still attract foreign investment, and more importantly, that they will be able to create new jobs, to decrease the number of unemployment people today. So new projects with the level of advance of Maricunga will play a very, very important role during the next 4 years for this new administration. We really think things are moving forward in a very positive way in Chile. And all these initial concerns and all these uncertainties created by this presidential election by year end last year, are now gone. And people is very, excited on being able to continue working with this new government and continue, creating value for the whole country and for all the companies on it. So that's it, Jane. Happy to open the Q&A session if you want now.
Wonderful, thank you for that. So Cristobal, we did have some audio issues throughout the presentation, and I think we've missed a few key points. So I might just jump into some questions here. Okay, so there's quite a few questions that have come through about the finance and offtake delays. Why are we moving the objective date further away with such a stellar DFS?
Okay, like I explained, sorry for this technical, issues. Like I was explaining, we are now talking with different financial institutions. They were all waiting for us to be able to release the DFS, as it is the key piece of information that it's needed to be able to execute a due diligence in the on the project. Now, the timings for those due diligences are something that is really not under our control, and we considered that it was appropriate for us to add, this additional time, and now be able to expect a final investment decision by the year end, and in order to start the construction immediately after. That doesn't mean that we're not going to do anything in the middle. This is the priority for this year. So basically, the sooner we can close this financing structuring, the better. There are, many alternatives that we're evaluating now, and like I said, a lot of interest from different financial institutions and potential equity, partners for the project.
Thanks, Cristobal. I might actually get you to turn your camera off again, just so we don't have any more audio issues. Okay.
Sorry.
That's okay. So why did we announce the updated DFS as a post-tax MPV and not as a before tax?
Now, that's very simple, because every company needs to pay taxes here in Chile. But so basically, any profits generated by MSP here in Chile, by the JV company, will need to pay some taxes. Tax rate here in Chile is 27% for every company. But we showed both, numbers, pre-tax and after-tax NPV.
Thank you. And are we planning to release a separate announcement explaining the combined metrics of stage 1 and 2?
But that's look, on on future expansions, everyone knows that we have been working a lot on what will be a future stage 2. Now, metrics will, and especially value and the cost of a future expansion will depend, mainly on the technology that will be used for to produce on this expansion, on this stage 2. And we haven't yet have a decision on which technology is going to be used. Like I said, we have been working with different providers of these new technologies, DLE technologies, basically, on the test of these of their technologies using Maricunga brine. Results have been very good. However, there is still some road, to be covered, and what we do expect is to be able to bring, and to be able to test those technologies directly outside during this year. Once we have that, a decision on which technology will be used will be able to be taken, and that will give us a clear picture of what will be the costs of the project, and in that way we will be able also to have a more clear picture of what will be this kind of less costs or savings that we will have on the future capex of this expansion. However, a future expansion will be probably at least the same size of the stage 1. You already have ADFS with a very clear, detailed, valuation for this stage 1. So regardless, the technology used, probably the valuation, will be very near to the one we have today. And if you consider that capex will be probably a little bit lower, the value of that, expansion should be, a little bit higher. Now, what we don't know yet, because as you all know, those are new code concessions, so we still need a license from the government, which is called the seal, and that will, create some or will define at the end of the day who will be our partner for the development of this future expansion.
Thanks, Cristobal. Just another one. So why was there not much difference between full equity funded NPV and half debt, half equity NPV? Well, given that debt is usually cheaper than equity.
Yeah, that's okay. It's a simple, answer there. It's the NPV doesn't change too much if you use debt or if you use full equity to finance it. The main difference comes on the side of the annual return, the IRR, because basically if you have a full equity IRR of, and I'm just using an example as an example, stage 1 of 29%, and you're able 50% of equity only, and the rest will be debt at a cost of 8%. So basically, you will be able to benefit of that debt that is costing you 8%, but you are generating 29% of IRR on that part of, the fund. Why your IRR will be, not always, but in this case will be much higher from on a levered basis than on a pure equity basis. And of course, the payback is also a little bit shorter, but it's all part of a basic financials here.
Cristobal, there's been quite a few questions about the increase in capex, and I know you did mention it in the chat, but we might have just missed out on some of the audio. So perhaps if you want to just touch on that.
Okay. The capex, even though the project is slightly smaller because we are reducing our production from 20,000 annual tons to 15.2, the capex is the reduction in the capex is not proportional. We do have a capex reduction on the direct costs of the capex, which is around 8% from the previous one. Remember, please, that the previous capex was closed by the end of 2018. So basically almost 2.5, 3 years ago. And from that moment until today, the increase on the main materials for the construction of different plants and for the infrastructure are up more than 60%, steel, titanium, etc., concrete. And also the cost of the labor is up. So basically, all those increases and all those new numbers have been considered and included on this new capex estimate that still is showing because of all the optimizations that we did in terms from a technical point of view, but it is still showing a decrease of around 8%. Now, the real difference came from the side of the indirect costs. On the previous capex of 2019, we had a very low indirect cost that basically is the one that considers or includes all the fees, commissions, and everything, and profits from the EPC companies and from all the other, suppliers that will participate during the construction of the project. Now, the stage one probably, and the numbers you're seeing on this DFS probably are the most realistic ones, or one of the most realistic ones in the market today, as we did use all the numbers that we received on the two proposals from two different international engineering companies that were Bechtel and Worley by the beginning of 2020, after the bidding process for the EPC that we executed for the regional project. So basically, those numbers, unless you have a real quote and a real proposal from an EPC company, are very difficult to be estimated, but these numbers are very realistic on that side. So that's basically why the capex was a little bit higher. Now, also, as you all know, we are using a not different, but we add something that is not being used by many other companies, which is a crystallization plant, which basically makes the whole operation much more stable, and it will let us, with a much bigger certainty, be able to produce a battery grade quality product, which is not easy in this industry.
Thank you, Cristobal. We've got time for one more. So there's been a few questions again about the MOU with Mitsui. Do you want to perhaps provide a bit of an update there?
Yeah, Mitsui, we continue working with them. Remember, the MOU with Mitsui has a broad scope on the side of the financing, on the side of the offtake and financing. They were waiting for us to finalize the DFS. Now that we did, due diligence from their side will start. They already have the consultants that will work on this due diligence here in Chile, as well as the law firm that will execute the legal due diligence for the project. So now it's a matter of time that that process starts, and it will probably take between 3 or 4 months until it is ready. But that's just an estimate, a personal estimate. That we will be able to confirm once the process is moving forward. Okay, but Mitsui continue working with us. They are super, interested on this and also on any future, expansion that we can have. Remember, one of the other parts of this MOU with Mitsui is this DLE technology, in which we have been working with them. Results have been very positive, and we, like I said, we expect to be able to start the tests outside as soon as possible during this year.
Wonderful. Well, thank you for that, Cristobal. And I think we have answered most of the questions here. If we have missed anything, please feel free to reach out via the contact details on the bottom of our ASX releases. And as I mentioned earlier, a copy of today's webinar will be available online. And I will do another run through of it just to make sure the audio is all there, but otherwise I'll get Cristobal to re-record. Thank you all for joining us.
Thank you, Jane.